Now, what happens if we do see some kind of resolution in the next couple of weeks? In terms of oil prices, we can still see them coming back down towards maybe $75 and $80 a barrel. They won't go down to where they were pre-war. Just because a truce has been signed doesn't necessarily mean that both sides can stop fighting.
Hello there, welcome to the show, and it's not every day we bring you a head of energy, someone that is in high demand right now. Welcome to the show, David Mirzai, head of energy research at SP Angel. How are you?
Hi, Angeline. Thanks for having me on. I'm very well, thank you. It's a nice sunny day in London.
Nice. So we'll get to the numbers in just a moment, but for our new viewers, those patching in, and also our long-time clients, give us a rundown of your experience, which is very impressive.
Okay. Well, I studied petroleum at university up in Aberdeen several years ago, as you can see from the hair. Um, I graduated. I interned at Texaco. I decided that the oil industry working offshore probably wasn't for me. I'd rather work in financial services, and I've been an E&P analyst for the last 20 years. Like all E&P analysts, I'm currently in transition. I do a range of kind of energy products, everything from helium to hydrogen-based fuels and fertilizers. And I also take a look at some renewables and CCS. But yeah, a bit of a mixed bag. But my first and best love is obviously oil and gas.
Let's quickly talk about that sector because, my goodness, what a wild ride. Those of in the market that thought maybe this might be a taco, maybe this might just last a few weeks. Well, here we are entering week 4. What's your base case?
So our base case is that if the war goes on for much longer, it's going to effectively cause a global recession. I think no one wants this. Well, possibly the Israelis are least minded by it, but certainly President Trump doesn't want to affect the war to start affecting people back home, and so he'll do anything he can to avoid that type of outcome. And you look at the initial market reaction following the start of the Iran US Israeli war, and it implied that the market thought this would be over quite quickly. That hasn't proven to be the case. And as you've seen from the tit-tat escalation in strikes, it ends up causing quite a lot of chaos and damage to the region, not less the world's economy.
Do we have dates here? Because, dates I'm always keen on because it gives our clients an idea of, potential entry, exit points. But when do you expect perhaps some sort of light at the end of the tunnel in terms of a reversal of these hostilities?
Yeah, well, I mean, the dates that we've had today, so far is the escalation started about 3 weeks ago. On Friday, you had Eid, which is the end of the Muslim celebration. On you also had Persian New Year, Nowruz, and that was on Friday. Traditionally, that would be a period of kind of great celebration, a lot of travel. I think people that had expected the war, the initial military strikes, to have largely wound down by now. The fact that they're still continuing and in fact have escalated over the last week is what has really driven oil prices above $100. Natural gas LNG prices are the equivalent of about $120 a barrel at the moment. And we've also seen you would also expect to see knock-on effects start coming through in terms of airplane fuel, in terms of fertilizer, in terms of food, just due to this huge kind of conflagration in the Middle East.
They must be listening in on our conversation, David, because we've just got headlines coming through from the FT saying Trump postpones attacks on energy sites after, quote, productive talks with Iran.
Yeah. Well, it's 6 a.m. Over on the East Coast, and if Trump is up this early, texting on his feed, then I imagine he's had quite a lot to kind of weigh up over the weekend. Yeah, I mean, I think it's been very clear that there's been different messaging from President Trump in the last 3 weeks. He keeps pointing to his European and guys. He keeps appealing to his domestic supporters that this is going to be a quick war, that this is going to be over very quickly, that he's almost done, that Iran is almost finished. And yet, the messaging to Iran and its leaders has been very firm. We will be there till we get the job done. We are prepared to stay there for as long as it takes. Um, I think the market tells you that it's taken a lot longer than it expected to, and there's still a huge kind of risk premium that it might escalate further from here. And that's why oil prices are over $100 a barrel.
So let's take a look at where oil is at right now. It's around 88, and it was high earlier on. But what's fair value to you? I remember us talking, and you were saying that perhaps there is this base case that there's still a lot of uncertainty, but maybe we might get some
Yeah,
clarity by Sunday, Easter Sunday.
yeah. If you go back to just before the conflict really escalated, oil prices were sitting at about $70 a barrel. That had already built into it, let's say, about a $10 premium for geopolitical risk, up from $60 a barrel. Oil prices at that level were relatively low because the roughly 3 million barrel a day surplus over the course of this year of supply over demand. Now, since the Middle East has been effectively shut, probably approaching maybe 90% of its production and output from that region, this has had a effect of somewhere in the region of 200 million barrels, 250 million barrels of supply not getting out over the last few weeks, and this has brought down that overhead and that kind of room for manoeuvre that the IEA had previously predicted. Now, what happens if we do see some kind of resolution in the next couple of weeks? I think in terms of oil prices, we can still see them coming back down towards maybe 75 and $80 a barrel. They won't go down to where they were pre-war because people will still factor in a potential future strike, be it from the Israelis or be it from the US, on Iran. As we've learned from Gaza and Lebanon, just because a truce has been signed doesn't necessarily mean that both sides are going to stop fighting.
Let's widen it out a bit now. How about LNG markets? I mean, we've spoken a lot about disruption there. That's a lot harder to turn the taps back on, right?
Yeah, I mean, this was the surprise in the market is that gas prices, LNG prices, didn't react sooner and harder to the rise in tensions in the Middle East. As people can imagine, oil is fairly easy to supply. To store around the world, it's an inert liquid for the most part, as long as you keep it in a controlled environment, and you can store it for long periods. You've got over 2 billion barrels of oil stored around the world. IEA announced last week that it was releasing 400 million barrels of oil from its stores to try and some of the oil that's been lost. That doesn't really happen with gas. Gas, as you can imagine, is a lot more difficult to store, especially when it's in liquid form. So the effects on the global gas markets have been pretty high. You've seen gas go effectively double. The European Union uses a TTF gas prices, which are priced in megawatt hours. So it's a kind of a power equivalency. They were previously at about €30 per megawatt hours, and they've doubled. I mean, this morning on my screens, it was $62, 62 euros per megawatt hours. But the fact that we had strikes last week on the Ras Laffan, and Qatar Energy then came out and said, even if the war ends tomorrow, we're not going to be able to bring that production back on. That product wait for repairs that will take maybe 3 to 5 years. This we're going to see a knock-on effect on the international LNG market a couple of years. And what you've seen in the gas price futures market is you've seen that back end of the curve, maybe 6, 12 months out, rising up by a good 15 or 20%, which you haven't seen with oil. What does that tell you? That tells you that people expect the oil trade to recover a lot quicker than the LNG trade.
So this one saying exposure to the LNG trade, which names should they be looking at?
Oh, but the easy names are going to be some of the big US ones. I mean, you had Venture Global recently IPO last year. It has one of the largest in the US, and it's building another one at the moment. And because a lot of its contracts are priced with regard to the spot market, any increase in international spot market may be beneficial to them. Now, it all gets a bit tricky from here because natural gas prices, US natural gas prices have effectively gone down in the last 3 weeks. Now, why is that? Well, that's a lot to do with some of the mild weather we've seen in the US and the fact that they're currently exporting as much as they can in the form of LNG. And so they don't have room really to take advantage of international higher prices internationally by exporting more. Now, albeit that will change over the next few years as more LNG capacity becomes available, it's not really going to do anything too much for their bottom line now. So maybe you want to be looking at some of the other carriers who have cargoes that they can put on the spot market. Now that's traditionally been people like Shell, people like Total, people like BP. But they themselves are suffering as well because a lot of their LNG capacity is actually sent east as well and can't get out of the Gulf. So yeah, I think it's going to be a very nuanced reaction as to who benefits the most. And it's got to do with where those contracts are tied to, Henry Hub or international markets, but also where that gas is coming from and whether or not it can get out in the current environment.
Very quickly, you cover helium and also fertilizers. Helium, is this a space that is likely to rally as well, given the conflict if it goes on?
Helium is actually a crucial critical mineral that is used for everything from semiconductors to high-end medical devices to rockets, to flush out a rocket before it fires off. A lot of people use helium because it's an inert gas. And so if you have an attack on one of the largest producers of helium gas in the world, and this is Qatar Energy's Ras Laffan facilities, that knocks out, for a start, there's no helium gas or helium in the form of liquid being exported at the moment. Then you know that it's also knocked out 2 trains of the 14 trains that are going to take a few more years to get back up and running. That's a permanent decrease. I think Qatar Energy estimated 14% of their helium capacity had been taken out by the attacks last week. Now, 14% may not seem a huge amount on one facility, but that facility provides 1/3 of the world's helium. So, although we can't really see the effect on prices because there's not a recognized international global price or exchange for helium exchange, I can tell you from what we've heard from a number of companies, it's helium prices, spot prices essentially, which are really going up in the near term.
Is that why we've seen Quantum Helium and the likes of Pulsar Helium, their shares remain quite robust since the conflict started?
Yeah, I mean, we have to, again, it's similar to the LNG story. You have companies at the moment that produce helium, but then you have some of those companies, they have a contracted helium price, so they won't be able to benefit from the increase in spot markets. Then you have people like, as you say, Pulsar Helium, people like Quantum Helium, who are in helium development. So again, they can't benefit immediately from an increase in spot helium prices. And what you're looking for is you're looking for those favoured few in the middle who sell their gas on the spot market and are able to react to the current price diversion with additional supplies, and it's those people or anyone who's ramping up helium production at the moment who will be able to benefit most. I expect. I imagine you'll see a similar story with helium. With fertilizer as well. The Middle East produces a lot of the world's fertilizer because it converts its natural gas and some of its petroleum products into helium, into fertilizer in terms of just upgrading the commodity so it fetches a higher price. Now, with the Strait of Hormuz effectively shut off, those fertilizer tankers can't leave the Gulf.
Yeah, some
And, I
60% of
expect,
urea, right?
yeah, the numbers are quite crazy. And again, it's people probably wouldn't have had much of an inkling that this what was an issue until they started reading about it in the papers. I mean, ironically, one of the other largest suppliers of natural gas and fertilizer in the world is Russia. And unfortunately, we can't get additional gas supplies. We can't get additional fertilizer supplies from Russia at the moment because that country's under embargo
So what
to a
should
large extent.
investors do? Should they be, looking to take a position in like the mosaics, the nutrients, the CF industries of the world? Are we there
I think
yet?
I'll be there, yeah. Well, again, I mean, this is Mr. Trump kind of playing the parade himself, and all the music could stop tomorrow. I mean, we've all played the game musical chairs before, and we know what happens if you don't have somewhere to sit and you're caught holding the parcel when the music stops. It's going to be very similar, you imagine, for industrial gases, petrochemicals, fertilizers, industrial stock. That at the moment, because there's a risk premium that the war could escalate in the Middle East, and prices are higher than they should be. But we can all see kind of a future where prices could come down considerably. Now, having said that, what I think your investors probably have to start looking at is that there's probably a very strong narrative over the last 5 years, which has been to a large extent anti-hydrocarbon. The oil and gas has been phased out, that renewables is coming, and it's going to block out any oil and gas requirements, and that to achieve net zero, be it by 2030, 2035, 2050, we're going to have stranded oil and gas assets. I'm hoping that what's happened in the last month should convince people that oil and gas plays a huge part of our economies. In the UK alone, oil and gas provides 75% of our energy needs, taken all together between motor fuel and aircraft fuel and electricity from gas power stations. Um, and that's going to change quite slowly over the next 10, 15, 20 years. And therefore, these kind of companies that have been out of favor traditionally because people didn't see a need for oil and gas in 15, 20 years' time, I'm hoping that investors will start to take a look at them again.
Right, thank you very much. We have to leave it there, David. Thank you so much for your precious time. I know it's really, really super busy for you, especially with what's happening in the Middle East. We will catch you offline. Any of you wanting to ask questions, please pop them below and slam the like and subscribe button and share with your like-minded friends too.
Thanks, Angeline. Goodbye.